single women or the women without partners, like you can do this. And I think women in particular hold themselves back in a lot of ways. So I just think we're more capable than we think. I still retired early, but here was the lucky thing for me. It's mostly because of real estate. I mean, it's not because of my 401k. It's not because of my investments. It's not because of compound interest. It's because of my real estate.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Welcome back, everybody. Another episode of the Millionaires Unveiled podcast. This is episode 221. This is Clark here with my co-host, Jace. Jace, what's going on?
Not a whole lot, man. How you doing?
Doing well. Nice cold January, right?
Nah, I'm down in Arizona, so it's beautiful here.
That's where you want to be. We've had some wind chill, and it's been like 1 degrees here. It feels like 1 degrees.
That's crazy. Yeah, that's chilly.
Pretty cold. Not as cold as skiing, though. I went skiing in Utah over the holidays, and it was night skiing, actually, and it felt, oh, man, it was cold.
Yeah, I'll bet.
It was cold. So we got a listener question this week from Justin talking about real estate LLC. So let me just read that, and then we'll talk a little bit about that. He says, after reviewing how real estate could work in my portfolio, I'm realizing that leverage is a great way to improve investment returns. However, my wife and I live by the philosophy of no debt. My question is it possible to have your real estate portfolio held under an LLC that shields your non-real estate net worth? What do you think about that, Jace, holding real estate in LLCs and how that affects your other investments?
Yeah, I think, first of all, just disclaimer, right? We're not attorneys. We are CPAs, but this isn't actual advice. But I think there's a couple things to think about as he poses his question. So one, he's trying to de-risk the fact that he would potentially be taking on debt for real estate as it relates to the other assets in his portfolio. And I think there's one thing to consider, maybe a couple of things to consider around that. But one is, typically retirement accounts and a few others, HSAs, et cetera, have some protections around certain creditors in terms of if something bad were to happen. There's a doomsday scenario, right? He's underwater. Could the bank, if he had to sell at a short sell or bankruptcy, would they be able to come after some of those other assets? And I don't know what his portfolio looks like, but that's just something to consider. The other thing is, not only because of 2008, but just in general, banks are smart in the sense that, hey, they don't want to lose their paper for these real estate assets, right? So de-risk for themselves, they require a down payment, right? So 10, 20, FHA 3.5%, good credit, etc. There's a couple things to consider as it relates to, putting property into an LLC and the reasons for doing so in terms of your risk from a tenant. There's other things you can put in place as it relates to insurance to kind of, I think there's a lot of different schools of thought as it relates to LLCs. It is definitely harder in some cases, unless you start going the portfolio route to get loans, than, if you were to have them in your individual name. But in terms of like a protection from risk of a tenant, there's different things you can do to make sure you're protected if you do have them in your personal name. But it's an interesting question, and I don't know the way that he's got it phrased. If he's really trying, I think the biggest thing he's trying to accomplish is he's worried that the debt could take down his whole portfolio. And I don't know that should be the mindset of, when you go buy a piece of property, you're going to end up putting 20% up, and that debt is collateralized essentially by that asset. You don't sign over a personal guarantee on all your other assets for that particular, property, so to speak. Now, there are terms in there in all these agreements nobody reads where, it makes it seem like, and could it stand up in court that they come after you and get some, but if you don't have a bunch of cash in the bank and just chose to walk away, it's pretty unlikely that I think that they would be able to, essentially penetrate all the other things that you may have to try to recover, $50,000 or $20,000, depending on, how much you're underwater.
Yeah, and just big picture, Justin, I think we have seen, Jace, correct me if I'm wrong here, but most of the millionaires that we've had on that have real estate do hold it in a separate LLC. That's what we've seen. And at least on one side, it's nice just to kind of have that kept as a separate entity and a separate business, in quotation marks business, but just in separate holdings. So I think you're spot on there with your answer though, Jace. So just as a quick recap from last week, we had Mike. He's 41 years old and is a police officer. I think just the second police officer we've had on our show. He has 3 kids, net worth of 1.5, which doesn't include his 60K pension. That'll be coming up here in the next few years when he hits, I think, 20 or 25 years in the police force. So he spends about $50K a year and is starting to think about the next phase of his life and what that looks like a little bit. So fun to talk with him. This week we have Melissa. She's recently retired just before she hit the age of 50, single, never married, no kids, net worth of $2 million. So we discuss her story, her journey and career as a single female and her corporate career using real estate and other investments to put her in a position to retire before 50. So she's obviously done phenomenally well. Congrats to Melissa, and we're grateful that she was willing to come on the show. If you'd like to ask a question to the Millionaire, send us an email, millionairesunveiled@gmail.com, or go to our website, millionairesunveiled.com, hit Ask a Millionaire, and you can record via SpeakPipe or submit a question just written in there. Just wanted to read a review that we got on iTunes here last month over the holiday break from Jack Bertini. It says, "Fantastic podcast. I stumbled upon this podcast when I was trying to find the Millionaire theme hour of the Dave Ramsey Show. After finding it, I've now listened to about 30 episodes over the past couple of weeks. All I can say is that this show is fantastic. They provide so much context for building wealth and different people's paths. It's fascinating hearing all the different stories of different strategies, people employ to become financially independent. Keep up the great work, guys. I can't wait to get through the rest of the episodes." So thanks to Jack. If you enjoy the show, we appreciate you leaving a 5-star review, iTunes or Stitcher, whatever platform you listen to. It helps us grow the show and reach out and get new Millionaire interviewee guests. So without any further delay, let's get into this week's episode with Melissa.
Melissa, do you want to just give us a little about your background and what you're up to now?
Sure. Yeah, I am recently retired just about a month ago now, just shy of my 50th birthday, been a professional executive level and decided to try to retire early. Originally thought it would be in my early 60s, but managed to hit it before 50, mostly through real estate. And just trying to figure out what's next. Never married, no kids, doing it on my own. And excited to kind of share my story with you guys over the next little bit.
Yeah, no, that's awesome. So retired at 50. Man, that is 49, just shy of your 50th. We won't age you. So going back, before we get into your allocation here, was it more of the number or was it the age, or what kind of drove you to pick right now as the time to do it?
I think honestly, it was, when I started out thinking about this, it was just lack of context, first of all. We can talk about it later, but I met with a fee-based financial advisor, just kind of, hiding under my desk saying, okay, tell me the bad news. Am I going to have to work till I die? Just not even knowing. And he was like, no, maybe we're looking at early 60s. And from there, it was a little bit of being self-competitive, for lack of anything better. We're like, well, okay, so maybe I can crack 60. And over time, it was just kind of accelerating it and thinking, okay, maybe I won't want to leave work earlier, but I want the possibility. And so year after year, it just sort of accelerated from there. And then, it just all of a sudden was like, okay, I could do it. And at that point, it coincided with, work being crazy and seeing, wanting to travel. Well, bad timing with COVID, but wanting to travel, wanting to explore what's next for me, wanting to explore interests and just deciding to go ahead and take the leap. Yeah. So for me, it was more about what was possible, thinking it wasn't possible, but realizing it was, being self-competitive, driving that number down, and then just deciding to kind of, sail off the edge of the earth and see what's next in a way.
How many years ago did you decide this?
So I first went to this financial planner in 2012, actually. So it was just over 8 years ago. And, again, had this conversation and was really pleasantly surprised that he even thought it was going to be the early 60s. And back then, and we can talk about that, I was just starting to, really enjoy real estate a little bit, but not, I was an accidental landlord at the time, but hadn't really jumped too much into real estate. And then things started to escalate. And then in 2018 is when things kind of hit high gear. I learned about the FIRE movement, so financial independence, retire early. And then the pieces just really clicked and kind of scrambled right to the finish line in the last 2 years. Things really accelerated at that point.
Okay. So what is your net worth then today?
So today I am just under 2 million net worth. I'm 11,000 short of 2 million, 1.988 as of the last time I checked.
Depends on how the properties are valued, right? Could be over.
Exactly.
So let's break that down a little bit. 2 million, let's just call rounding and up 2 million. How is that broken up?
Sure. So it's just under 60% real estate. So if you want to get precise, it's about 58% real estate. So that's just about 1.15 million in equity. And so, I can kind of drill even further. I own 5 properties. 2 of those are my quote unquote homes. So I have my primary residence is a condo that's paid off, Florida. And then I have a second home, which is also a condo in the North Shore of the Boston area, which is also paid off. Both of those I use as short-term rentals, actually, when I'm not in either location. So those provide some income. Both of those are paid off. Those between them are about $530,000. Then I have 3 rentals. All 3 of them are multifamilies. So one of them is a triplex in the Boston area. That one's worth about $760,000. That is mortgaged, about 46% equity. And then the last 2 rentals I got are in New Hampshire. They're both 4plexes, and they're each worth about $380,000, and those are mortgaged as well with about 37% equity each.
So you get this real estate, and then do you have some kept in cash as well on the side for these? And how much is that approximately? Yeah.
So this would be controversial to other quote unquote real estate investors. So as I said, I've got about 58% of my worth is in real estate. I have quite a bit in cash, so about 13.5%. So $270,000 are sitting in, we would call them high yield savings accounts. It's not so high yield these days, but is basically in cash, sitting in various savings accounts. And the reason for that is basically, I am not working a W-2 job anymore. I'm quote unquote retired. So I have a bunch of capital expenditures I'll probably need to have over the next, I would say 5 to 7 years, potential roofs or kitchens to renovate or, heaters and boilers to go. And so I want to make sure that I'm not risking that. So I have quite a heavy cash position. So again, a lot of people would be like, oh my gosh, you're not earning anything on that. But I just believe anything that you're going to need in the next 5 to 7 years, for me personally, I don't want to risk that. So I keep that in cash. So I have that in cash. And then the balance, so I've got about 24% that's in my 401k. So that's about $480,000. And I can talk about the breakdown of that. And then the balance is just like 3.5% is in a post-tax Vanguard index fund. And the 401k and the index fund account, they're pretty heavily into stocks, very little in bonds. And that's primarily because I have so much cash. So my age, I'm 50. I think I've got about maybe 20% bond. I don't have a ton in the bonds because I do have a lot of cash.
Wow, interesting. So, Melissa, you're on top of this stuff.
Well, I've been, especially the last 2 years, crunching, recrunching, triple crunching my numbers just to make sure I could take the leap and rethinking, diving into a lot of podcasts. And, again, I think, a lot of people could question my mix, but for me, I think with my risk tolerance, it works.
I mean that totally complimentary. I mean, when Jace was asking you about that real estate, you were spitting off those LTV ratios like nobody we've had on this show. So way to go. I mean, that's awesome.
Yeah.
So just real quick, I mean, I think we've had big picture on the portfolio allocation, but in the 401k retirement accounts, you have about, I think close to 500, right? 480-ish.
Yeah.
How much is that? Index funds, mutual funds, single stocks? What's there? And then we'll roll into your story a little bit in the real estate.
Yeah. So the 401k, so this is actually, I'm about to hopefully roll this. So this has been, as I said, I just retired about a month ago. So this has been in the company I work for, Fidelity 401k offering. And their offering is fairly limited. So they're in Fidelity, a lot of, they're not single stocks, they're sort of mutual funds. They're, domestic, 60% domestic, 20% international. So mostly large and mid cap. I don't, to be honest, guys, and this is where, you guys have been really impressed with my real estate side. The stock topic kind of makes my eyes roll back in my head a little bit, which is why I went the real estate route. So this is where my financial advisor helped. He would look at what my company offered and would make some recommendations. It's done fairly well. But it's not where my interest lies. So, it is about, again, 80% stock mix, large to mid cap mostly, and then 20% bond mix. So it's like, I don't think they don't really have a lot of the index fund options for my company. They don't have those offerings. So I'm probably going to roll it all over to Vanguard, where I understand it a little bit more, since I've done that work myself with the post-tax account. And I'll do the whole.
Yeah, I got you. That's what I was going to ask you, if you were going to roll it out of the 401k into an IRA.
Yep, I'm going to do it into the my own money. I've put into VTSAX. I've got a little bit in sort of a target, a little bit into the target retirement account, just because that's the Vanguard. I have a little bit. That's a little bit more of my CapEx next egg. That's kind of the 7 to 10 year target. Then I've got VTIAX, which is that broad market international. But yeah, I understand those a little bit more, and I can do better research, but I'm probably going to just roll the 401k directly into Vanguard, so I can do my work and I don't have two places I have to look into.
Yeah. So the $500,000 in retirement is 401k money that you're going to roll. Is that in Roth or after-tax money? Or pre-tax money? Is it Roth or traditional?
401k or the Vanguard money that I already have?
Both. What's your take on the split there?
Yeah, the 401k is pre-tax. So I'm going to do one of those direct, I forget what they call, but it's like a direct rollover to I think it's going to be a direct rollover, they call it, or something like that, to a trad IRA. Mm-hmm. Just, so it kind of goes directly over, so I don't get hit with any penalties or anything. So that's what I'll do there. And then the other, it's about $65,000 that I've done in post-tax money, which is separate. So that is just literally, that started out because when I've worked overseas, when I was working in London, I didn't have an opportunity to invest in my 401k. It's actually why my 401k from my age is, I think, a little lower than I would like to see. I actually worked overseas for 6 to 7 of my highest earning years. So I was working in a place where I couldn't contribute to a 401k. So the last couple of years, I would just kind of throw money into post-tax index funds with Vanguard.
Yeah, thanks for sharing. And so let me just keep going on this 401k piece a little bit. And I know we're jumping around here, so apologies. But in the notes you shared with us before the show, you mentioned that you feel like you didn't really start pushing on your 401k as early maybe as you should have.
Yes.
So I'm just curious to get your take there. And I mean, if you consider it a mistake, I don't know, or the advice you give in terms of the 401k.
Yeah, no, that's a great question. It is. It's sort of one of my big regrets. So growing up, I would say, so I grew up single mom. We did not have a lot of money. We were, definitely scrambling, and we never talked about money other than, we didn't have a lot. So didn't have a lot of guidance in personal finance. We just didn't know much. And so when I started working, of course, at work, they would talk about enrolling in your 401k, and I knew it was a quote unquote good thing to do. But I didn't do it for a while. And then in my 20s, my mid 20s, I did, but I, certainly wasn't maxing out, wasn't anywhere close. And it wasn't until my later 20s, I would say, that I started investing more, but I never maxed it for quite a long time. I would say until, I hit my late 30s, 40s even. And then, as I said, basically, as I was hitting my 30s, I was pulled out of the U.S. employment market, and I was working in Europe, and I couldn't invest in my 401k. So, I think during those years when compound interest was going to be my friend, I never heard the terms compound interest in my 20s. I never even heard any of this. So it is a big regret for me. And, I certainly, when I see on these kind of, financial independence, Facebook groups and stuff, when people are like, hey, what would you say to people in their 20s? What would you say to people in their 30s? It's the number one thing I say, push money into these pre-tax accounts, your 401k, because first of all, the impact that you feel is so much less because, once you get it post-tax, that $1,000 doesn't feel like $1,000 post-tax, and that compound interest over time, it's just amazing what it does. And I didn't understand that until just a few years ago. So already talking with my nephews, my 11 and 13-year-old nephews are already investing. We've been doing compound interest lessons. Interesting to try to explain that to a 10-year-old on what compound interest is, but we've done it, and we've opened little accounts for them, and they're already doing it. So yeah.
So how did you pick it up then, Melissa? Where did you feel like you were, if you caught it late or learned it late, how did you learn it? Where did it come from?
I had an uncle who is just very, very disciplined. My aunt married a very disciplined guy. So he was the one, first of all, that was just talking about, don't have credit card debt, helped me put a budget together, helped me figure out some of that. So that was a help. Still wasn't really hearing about compound interest. And so it really wasn't until, honestly, the whole where compound interest clicked wasn't until I really heard about the FIRE movement. And, by that point it was too late. I was contributing to my 401k though, because I understood I should be doing that for retirement, but I didn't really get the whole impact of why. But I was luckily earning enough that felt like an important thing to do. So I was doing it. So it was.
And you still retired early.
I still retired early, but here was the lucky thing for me. It's mostly because of real estate. It's not because of my 401k. It's not because of my investments. It's not because of compound interest. It's because of my real estate. And that was just a love and a passion. So that's what's interesting for me is it has nothing to do with my 401k and has nothing to do with investments in my story. It has to do with real estate. So.
Yeah, really interesting. And let's jump into that right after this. I just want to go back to the one thing you mentioned, that you said you grew up with a single mom and you didn't really talk too much about money. How do you think that's influenced you now? Or as you went throughout your career and now you've been on your journey? It's amazing, right? $2 million. But how did that affect you?
It definitely did. I think in a few ways. I think the person that I am and the place that I am has a lot to do with that. I think the first thing is it gave me, in a healthy way, I think, a bit of a scarcity mindset. I always wanted to make sure that I saved, that I was not putting myself in a vulnerable position financially. So I was not getting into trouble. In college, like we all did, they gave us a credit card and we made stupid choices. I bought too many Gap sweaters. So like I said, my uncle helped put me on a budget and I got out of that right after college. But from that point, I never put myself in a bad position. So I would check and double check my numbers when I bought my first condo when I was 27 or 28. I checked and double checked and triple checked that I was not going to have to, eat mac and cheese, that I could afford it and still save. So I always saved because I wanted to make sure that I was okay. And so financially, I think it put me in that mindset of saving and living beneath my means. So I think that was one thing. It also gave me a very strong, I think, work ethic. I had a job from the time I could legally work and help contribute. And I think that's really healthy. And, I worry a little bit about, kids that have too much now. I think it's important that kids work. In college, I had to work for my room and board. I was an RA, so I could get my room and board covered. I worked throughout college. I think that's important. And so I think all of that has served me. I actually think it's a really good thing that I had to scrap and save. And I think all of that has served me really well and helped me to come to where I am. It also, I had to risk a little bit as well, right? When you're young and you have to work and you have to, kind of get out on the scary ledge a little bit, it also makes some of these risks like buying real estate, you learn how to take some of that healthy risk as well. You fall on your face, but then you have to dust yourself off and pick yourself up. So you learn some self-reliance as well. So all of that I think is healthy and good.
And now let's take a quick break to talk about today's sponsor, Wix. There's so many options out there to get started, a business, a website. It's really hard to know how to start, what to choose. And that's where Wix comes in. You take your business online with Wix. It's the leading website creation platform that's got all the tools you need to create, manage, and grow your brand. Whether you're starting an online business or you've got a side hustle or you've got a business that's already flourishing, you can design a site, showcase your brand, and that'll look great on any device. Clark, it reminds me, we probably should have used Wix when we started. I can't even remember what we used. But anyway, join over 200 million people already using Wix's wide range of solutions to enhance their business. Ultra smart SEO tools designed to get you found on search engines, faster loading times to create outstanding user experiences, which we know is extremely important. If you don't get that website loaded quickly, boom, you're bouncing. And payment solutions to help you boost your revenue. You can manage everything from one dashboard on desktop or mobile, so you can be available anywhere at any time, in the office, at home, or on the go. Want to get started? Head over to Wix.com and create your website today.
Yeah, so Melissa, I want to get into this real estate. When did you start getting interested in it, and maybe start walking us through that first deal?
Yeah, sure. So there's always been, listen, I remember the town next to where I grew up has all these beautiful Victorian houses. I remember being a teenager and looking at these beautiful Victorian houses thinking I wanted to live in one someday. So I think I've always sort of had this bit of a love of architecture and beautiful houses and real estate. So it's always a little bit been there. So I guess, like everyone, you start out somewhere and you buy your first property. I guess where I would start then from this purpose is I became a bit of an accidental landlord. So I mentioned I've worked overseas. So one of those opportunities came up one day quite suddenly where I had bought a condo and was living there quite happily. And then work had offered me an opportunity to move to Switzerland. And it was very sudden. It was pretty much, we need you to go in the next, 6 to 8 weeks. And I was like, oh, okay, I just bought this condo and I'm living in this condo. What do I do? And so the person I worked with was looking for a place to live. And so next thing I knew, I was a landlord to a person I worked with. And it kind of got me over the hump. And so now I was kind of a landlord. But luckily it was a person I knew. So it was a little less scary and had a good experience. And it kind of got me to think, okay, here's something that I can do. And as I'm working in Switzerland and I'm saving money and at this point, so this was 2006. And then I'm still living in Switzerland, 2008 happens, 2009, and the market crashes. And all of a sudden, actually in that town I just mentioned, I didn't even think of that, this beautiful Victorian town, I come home and this beautiful house, I go to open houses all the time. This beautiful Victorian house is for sale and I walk through and I fall in love with it. But this is silly. I live in Switzerland and the prices are falling and falling and falling. So anyway, I buy this house because the prices fall, even though I'm renting out my condo. So I buy this house because the prices had fallen so much. And so I continue to, when I move back from Switzerland, now I've got this Victorian house that I'm living in. I still keep the rental. And anyway, that's kind of how I get started. So over time, this kind of gets me thinking, okay, so now I have a home and I have a rental. So that's basically how it started. And and so then I managed to get lucky. And that Victorian I bought was in a town that started really climbing and had fixed that house up a little bit, sold it for, a bit of a nice little profit, and then bought a fixer-upper. And then got this in my mind, this idea of two things. One was, with your own primary residence, you can sort of buy a house. I bought a real ugly house, the typical ugly house on a beautiful street. Buy it, renovate it, live in it for 2 years to wait out the capital gains, and then sell it. So I have that idea, and maybe I'll buy another duplex at the same time. So that's what I did. I just started going from there. And this is when I was talking to my financial planner. This is when I started thinking, how do I really accelerate this? So in the meantime, I sold the condo, made a little bit of money on there. So now I've got a couple of dollars here to play for some down payment. So that Victorian that I sold gave me enough of a down payment so that I could buy this crappy fixer-upper for a a new house for me, because it was like, I sold my other primary residence, that Victorian, for like $620. I bought this crappy house for $400. And so I still had money then to look at, with the condo being sold, to look at a duplex at the same time. So now I'm really going. So I bought a duplex as well, both in this town that's kind of now starting to rise in the market. So that's kind of what happened. I got a little greedy and excited, but it worked.
So really, a lot of your wealth has really been created in the last decade, right?
Yes.
Do you remember what your net worth was maybe around your 40th birthday?
Yeah. So it's funny because, when we talked about doing this, I had actually asked Sebastian, who's my financial planner, to just go back and look at the records just to see sort of where we were, because I hadn't remembered where we were. So let's see, so when we first started in 2012, so that was, 10 years ago. So that's around then. Yeah, that's probably right around when I was 40, right? Am I doing the math right? 10 years ago. Yeah, my net worth was $438,000.
Wow. And you remember what it was at 30?
Oh, I didn't even know how to calculate it at 30. I had no idea what such a thing was. I mean, I didn't even know he was tracking it in 2012.
Yeah.
I wouldn't have even known how to calculate it at 30.
Totally. So you've gone on this great journey. Now you retired before 50. What is the outlook and the plan going forward here? And as you moved into this phase of retirement, we have a lot of people ask, how to make the transition. What do you look for into retirement? Because a lot of people are kind of like, I probably need to retire to something so that I'm not just bored. Yeah. What are you doing to fill your time? What are you doing to make life still exciting without, having a day-to-day job or working?
That's such a great question, because I think my situation is interesting in the sense that, I'm not married and I don't have kids, right? And I think those are two big, focuses for people in terms of what's going to take your time. And a lot of the literature, a lot of the books out there and the podcasts and the blogs are around the money piece of it. How do you get there? How do you get there? Money piece. And my career has been incredibly fulfilling. I was very lucky socially, from a sense of self-worth, and it certainly kept me very busy. And it's interesting. I read this book. It's a bit outdated, but I found it really helpful. It's called something like How to Retire Happy, Wild, and Free. Really, it's about all that other stuff. It's like, okay, yeah, the financial stuff, there's a ton of books out there, but it's really about, okay, how do you think about the social piece? If your friends are working, how do you think about, social connection and, making sure that you're nurturing your friendships and having social, I'm an introvert, but I'm still going to need social connection. How do you make sure that you're thinking about, keeping your brain sharp and challenging yourself mentally? My job was very mentally challenging. So how do you do that? How do you make sure that you're keeping busy and not just sitting around watching Netflix all day? How do you make sure you're doing things that have meaning? So they help with some frameworks for that, and like interest trees. And so I've got a whole notebook full of, if an emergency break glass, creative interests that I want to pursue. I think intellectual interests I want to pursue, things that I've had to put on hold. So I've got a whole list of things that I want to do and I'm planning to pursue. I'm a month in, right? So I'm still in this weird place where I'm still like, oh, it's the weekend, so I can, oh, wait, I don't have to wait till the weekend to call someone or do something. So I'm still very much in adjustment mode. And I think that's pretty natural. I'm still swinging a bit on the pendulum from, spending days running around like crazy, painting cabinets, to another day just watching Netflix. But I'm also understanding that it's going to take time. So I'm trying to find the new normal right now. I'm trying to find new patterns and routines. But all of those things, I think, we need to do more in our space to talk about that. I don't think there's enough being talked about. I think we have to really make sure we're retiring to something and taking care of all of those pieces, our brains, our health, our bodies, our social networks. So I've tried to think through it, but I also am trying to be patient with myself that it is going to be a journey. So I've got lists and lists and lists but I also know that I have to be patient and expect the unexpected and see what happens. But I've got also a couple little side hustle ideas and little things that I can always, scale up a little bit if I'm finding that my interests in upholstering and painting cabinets isn't taking up enough time.
Yeah, good answer. Thank you. So as you look back, Melissa, I mean, Jace just asked about the future going forward, but as you look back now on your career, do you feel like you managed it well in terms of work-life balance? Do you feel like you would have made any adjustments there or spending more money early or spending more money later? I mean, are you pretty happy with that split?
Yeah, that's such a great question. So I was just speaking with actually a woman who we bumped into each other on one of these financial independence Facebook groups, and she worked for me about, no lie, like 18 years ago. So I was with the same company for, believe it or not, 24 years. And I haven't seen her since. And we found each other on one of these sites, and we just had a great catch up on Zoom. And she did a totally different path where she took kind of these little mini retirements every 7 years or so. And I never knew such a thing was possible. I just sprinted and then kind of now like panting, didn't hit the wall, but kind of hit the wall, right? And now I'm done at 50. And if I could have done it over, it's not about the money. I'm happy with what I did with the money, but I never knew it was a possibility to kind of take a year off and, travel and take a breather. I just didn't even know such a thing existed. So, I learned about this space and these things in 2018. And by that point, I was almost there. So it's like, okay, we'll just grind it out for another year or two and be done. But had I known, I just feel like that's a healthier way to go about it. I just really ran full tilt for my entire career. I don't have any regrets. I loved my career, but I do think it's not necessarily the healthiest way. So, if I were to advise someone who is earlier on in their career, I might say, think about that. Do you have a career where you can kind of take a pause, take a few months to, drive cross country and recharge a bit and then come back at it? I think people that do that are very brave and very smart. And that just wasn't my journey, but I didn't even know such a thing was possible. So I think I have a lot of hope for the next generation of folks doing this early retirement thing.
Yeah. So now in terms of spending in retirement and what that looks like for you, I assume you're planning to draw down from the cash flow or just live off the cash flow from the real estate.
Correct. Yeah. So that's the plan. So as I'm sure you can tell with all my numbers, I sit here and I'm a big YNAB fan. So I'm like in my YNAB app, like daily, all the time. So I'm checking on all my accounts and watching the cash flow. I'm also looking at, the places where there's still opportunity within the properties. I picked properties where there's still potential, for upside. There's still some units that can be, as the tenants turn over, we can still upgrade them and command more rent. But in general, I'm in maintenance mode. Yeah, it's kind of, caring for the nest, making sure I might invest some this year of like, okay, that boiler is really old. So let's just go ahead and replace it now. So I'm getting more energy efficiency and I'm not dealing with maintenance costs over time and just trying to, maybe invest some, upfront. So I'm not getting nickel and dimed by some of these costs later on. So, but overall, I should be able to kind of care for the nest and see the, 401k grow and see the properties appreciate and live on the cash flow of the rental income. That's the hope.
So 2 condos, correct me if I'm wrong here, 2 condos, 2 fourplexes and a triplex. Is that right? That's right.
And in the plan, I've built in some conservative amounts, like the short-term rental amounts that I've budgeted on are pretty, I've kept it very conservative, that if I could definitely push to try to rent more. I think I budgeted on $10,000 a year, which I can do very, very easily. So I could always do more. And I've got a side hustle that I know I can easily do more than what I plan to do. So I've also built in a plan that's very conservative. So if I wanted to push it, I could.
So how much, I assume you'll live in one of the condos and rent out the others, or you'll, as you mentioned, you'll short-term rental, whichever one you're not in. How much do you expect that all that real estate will cash flow to you annually?
Yep. So the long-term rentals, so all the multifamilies, the 3 multifamilies, should cash flow about $55,000 a year. And then the 2 condos, when I'm not in one or the other, should bring me a minimum of $10,000. So between those is $65,000 a year. And then I've got just kind of a part-time gig, a few hours a week, basically contracting with my old company that they've said I could do more anytime I want, but basically that should be about $25,000 a year. So we're looking at about, yeah, they've been lovely and very, very kind. And, obviously I've worked very hard, so it's not charity, but it's, they've been very, very good to me. So yeah.
Yeah. So it's interesting when I think duplex, and maybe I'm wrong here, but when I think duplex, I'm like, okay, $200,000-$300,000, but you're buying higher end. I mean, you share at least one of them, right? I mean, I'm just curious because I'm looking through these notes here, and you bought one for about $520,000, right? You mentioned you put in $24,000.
The Boston area is, it's pricey. So the triplex I own now, I bought for $625,000. Right. So, and it's now worth $7, it depends on which site you look at. It probably would sell in the mid to high 7s, right now. And the rents right now are I should know that off the top of my head. It's basically like $6,300 a month in gross rents.
Good for you. And just, you mentioned here, I think this is really interesting. You said, in one case, I bought a duplex for $522,000.
Yep.
I put $24,000 into it, owned it for 2.5 years, and sold it for $751,000, a 38% return, about $200,000 profit. It's pretty amazing.
Yeah, that was that town that I mentioned earlier that was literally skyrocketing. So that time that I said that I bought a primary residence, a real dud an ugly fixer-upper, and a duplex at the same time, this town was literally catching fire. So both of those, that primary residence and that duplex, I was able to turn around for pretty big profits. And again, that's counterintuitive. People are like 1031 exchange. I did not 1031 exchange that property because it was very hard to find a new property in the time. It's very limited time you have to, if you don't know what a 1030, well, you guys might, but if your audience doesn't know what a 1031 exchange is, that basically means it's a tax shelter. You have to, within, I think it's 30 days, identify a new property that's about a similar type and price property, and within 90 days close on that property. Roughly, that might be wrong, but something like that. So it's very fast. You have to find and buy a new property to shelter that money. And in my mind, if I was looking around, didn't see anything, and I didn't want to make a dumb choice and just buy something for the sake of buying something and then be stuck with this property that I'd made a fast, hasty decision. And in my mind, I mean, that's $200,000 of profit. And yes, I had to pay 20% of tax on that. So $40,000 went to Uncle Sam, but I still made $160,000. So, I didn't, that to me is like, you know what? I don't have a problem with that. That's all good in my book. So yeah, that was lucky.
Yeah, and you didn't. Yeah, and you mentioned in the notes that you didn't want to get into something that wasn't a very good deal just to 1031 it.
Exactly. To me, that's not smart. That's like, the tail wagging the dog just to, save the tax till later. I mean, you still end up paying it at the end of it someday. You do pay it eventually, just not right now. So it just didn't make sense to me. I didn't want to. It felt too rushed. It felt like the deals that were out there weren't deals. So I ended up just, paying that tax the way it is. Sometimes you pay the tax.
Yeah. I thought this was really funny and interesting. You said, I jumped into my first rental property before I understood how to properly evaluate if numbers would work. I just looked at a simplistic gross rent minus mortgage payment, which clearly is not how it's done. Ugh.
No. Yeah, shame on me. So that's one of the mistakes. I mean, I've definitely made some mistakes in my day, and I got really excited, oh, yeah. Okay, so, the rents are going to be $3,000 and my mortgage is $2,000. That's awesome. And wasn't thinking about maintenance costs and wasn't thinking about CapEx and wasn't thinking about vacancies and, and I didn't do my research, and shame on me. That happened to be the property that I ended up making that profit on because I hit that right town. But I mean, shame on me. I shouldn't have done that. You don't get into investing before you do all the research, right? So, I mean, I still learned that lesson. I was embarrassed. I had my tail between my legs, and it taught me to do my research. I happened to, the universe was looking out for me, and that it ended up being a good appreciation. But my goal isn't appreciation on this. My goal is cash flow. My goal is retirement income. So I made a bad decision from that perspective, and I just happened to get lucky. So yeah, I mean, it's a lot of money to be spending, $500,000 investment to be making, not all cash, obviously, but that's a big investment to be making without putting a lot of research into it. So that's my other advice is, when you're investing, do your research and know what you're doing and talking about. And it's a little embarrassing, but I think it's important to talk about. I mean, we do make mistakes.
I appreciate you sharing. You've obviously been very successful in real estate, so not at all. Let me just ask you a few rapid fire questions, and then we'll wrap it up here. So, what's the most expensive car you've ever purchased?
Oh, I mean, I guess probably 20,000. I mean, I still bought used, but a Mini Cooper, my used Mini Cooper Countryman was probably 19,500. Really not a big car person.
Yeah. What about the most expensive meal out that you've personally paid for?
Oh, Mykonos on the ocean, ridiculously expensive fish dinner was probably my portion was probably $150. I don't care. It was worth it. It was beautiful.
Okay, what's worth the money and what's not worth the money?
Experiences, travel's worth the money for sure. To me, gadgets, not worth the money. It's not my thing.
Okay, without me asking your age, how old were you when you became a millionaire?
Well, I've already told you my age, so no big deal there. I became a millionaire, luckily, thank you, Sebastian. It was sometime, I guess, in 2016. So it was about...
So the second million came in 4 years.
Yeah.
Okay. I know you used a financial advisor. Just real quick, what was your experience there?
I had a really good experience. I think what he helped me do is contextualize a lot and hold me accountable. Not hold me accountable, but just knowing I was going to meet with him twice a year was really helpful. And he created a framework for me. So I paid him, a certain flat fee every year. We met twice a year. He helped me not only kind of put all these numbers together. And then when I came up with my retirement plan, I put my retirement budget together on what I needed to live on. And he helped me kind of poke holes in it. Hey, did you think about taxes? You're going to have to pay taxes. You won't have a W-2 income to be taking taxes out. Did you think about healthcare and what are you going to do for healthcare? So he really helped me build a lot of this out. So that was helpful just to have a speaking partner for that, given that, again, I didn't really grow up thinking about a lot of this stuff. So having that speaking partner for me personally, I found helpful.
Great. Annual household spending. How much do you spend a year?
How much have I spent a year? How much will I be spending a year now in retirement?
That could be a big difference.
It could be a big difference. And I think it has been. I mean, my spending now, and again, spending is tricky for me because I guess I would need to split out, I guess, what I spend on the properties, right? For maintenance and things like that.
I'm thinking, more just like personal expenses, travel, food. Yeah.
Travel, food. Yeah. So it's I guess not including, we're around around 80,000, I would say.
Okay.
Yeah, around 80,000.
Okay. Has the money, as the net worth's grown and as you've grown this nest egg in the money, I mean, has it made you happier? Has it made you more confident or more fulfilled?
Happier, no. I think it's definitely building towards retirement has made me really excited. I think that freedom has made me excited. It's not about the money for me. It's about the possibilities and excitement to think what's next. So I think that has made me satisfied. The safety and the security, the way I grew up, definitely feels really good. Happy. Money doesn't make me happy. I think what I do with the money hopefully makes me happy and being intentional with it. But I definitely feel proud and I definitely feel excited and I definitely feel, I'm excited for what's next. So I think all those good things.
Yeah. Any big plans here in retirement? Fun trips, big purchases, anything coming up?
gosh, when these vaccines are in our arms and the, borders open, this girl is like, I've got all kinds of trips planned. So yeah, I can't wait to travel again.
Yeah.
I've got Airbnbs tagged. I've got Southeast Asia plans sketched out. I've got all kinds of stuff going.
Well, what a great interview, Melissa. Thank you. So just in closing here, what advice would you give to somebody who's just starting off their journey, someone who's in their young 30s, or maybe they're single and not married? I mean, couple it however you want, but what would be your advice or any last mistakes that you'd want to share to avoid against?
I mean, I guess the biggest thing I would just say is I guess I would just say it's possible, right? Like, don't think it's impossible. It's possible. And don't let limiting beliefs get in your way. And I guess the other thing I would just say is for the women out there, and especially the single women or the women without partners, like, you can do this. And I think women in particular hold themselves back in a lot of ways. So I just think we're more capable than we think. We're more powerful than we think. And so I just think folks in general should just try and we have more potential than we think we do. So put the money in the 401k. Definitely do that. And really, I think one of the things I think is figure out what interests you. Don't do real estate because I did real estate if real estate doesn't interest you. If index funds interest you, you find what interests you and do that. But it is possible. So yeah, don't hold yourself back. Yeah.
Awesome. Thank you. Again, everybody, that's Melissa. Net worth of $2 million. Got her second million in the last 4 years here. So congratulations on your success, and thanks for coming on.
Thanks, guys. Appreciate it.
Thanks, Melissa.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.